So you're deciding between blue chip stocks and cheap stocks. One costs hundreds of dollars a share and barely moves. The other costs pennies and could triple by Friday. Here's the part nobody tells you. The cheap stock isn't actually the higher return investment. In almost every measurable way, it's the worst bet, and the math behind why is more brutal than most people realize. Let's start with what these two categories actually are, because the terminology confuses more people than it clarifies. A blue chip stock, the term borrowed from poker, where blue chips hold the highest table value, refers to a large, well-established company, usually with a market capitalization above $10 billion, dollars, a long history of stable earnings, and often a track record of paying dividends for decades without interruption. Think Coca-Cola, Johnson & Johnson, Procter & Gamble. These are companies that have survived multiple recessions, multiple wars, multiple technological upheavals, and kept generating profit through all of it. A cheap stock, colloquially a penny stock, is something else entirely. Technically, it refers to any share trading under $5, though the real defining feature isn't the price tag, it's where these stocks actually trade. Most penny stocks aren't listed on the New York Stock Exchange or the NASDAQ at all. They trade over the counter on markets like the OTC Bulletin Board or the Pink Sheets, venues with dramatically lighter reporting requirements than the major exchanges. A company on the Pink Sheets can, in some cases, disclose almost nothing about its finances to the public at all. That single structural difference, not the share price, is what actually separates these two categories, and it's the difference that ends up mattering most. Here's the first place the math gets brutal. Standard deviation is how investors measure how wildly a stock's returns swing from year to year. And the gap between these two categories isn't small. Large cap stocks have historically shown an annual standard deviation around 20%. Small cap stocks run closer to 32%, and that's still measuring companies large enough to be listed on a real exchange. Penny stocks, sitting even further down the size spectrum on markets with even less oversight, routinely see single-session price swings of 50% or more. That's not a rough day. That's a stock that can lose half its value between breakfast and lunch, for no company-specific reason at all, purely because there are so few shares actually trading that a handful of orders can move the price violently in either direction. That thin trading volume creates a second problem almost nobody thinks about until they're already stuck with it. Liquidity, the ability to actually sell a stock when you want to. A blue chip stock like Coca-Cola trades tens of millions of shares a day. If you want to sell, there's always a buyer on the other side at a price close to what you see on your screen. A penny stock might trade a few hundred shares a day. If you own a meaningful position and decide to sell, you may not find a buyer at all, or you may find one only after the price has crashed to attract them. The stock you thought was worth a certain amount on paper turns out to be worth substantially less the moment you actually try to convert it into cash. Now here's where the two categories diverge most sharply, and it isn't really about risk tolerance at all. It's about what you're actually buying. When you buy a share of a blue chip company, you're buying a claim on a business that already generates real, audited, verifiable profit year after year. The return you're underwriting is the compounding of that existing profit over time. When you buy a penny stock, in the overwhelming majority of cases, you're buying a claim on a company that has never been profitable, may have no real product at all, and is often structurally betting entirely on someone else being willing to buy your shares for more than you paid, regardless of whether the underlying business ever does anything at all. One of these is an investment in compounding. The other is much closer to a bet on future buyer enthusiasm. That distinction matters because it explains why penny stocks are, structurally, the preferred vehicle for a specific kind of fraud, one that doesn't really exist in the blue chip world at all. It's called a pump and dump. A promoter quietly accumulates a large position in a thinly traded, obscure company, often for fractions of a cent per share. They then aggressively market the stock through newsletters, cold calls, social media, or boiler room phone banks, making exaggerated or fabricated claims about the company's prospects. As unsuspecting investors buy in, the price climbs, purely from the new demand, not from anything happening inside the business. Once the price has climbed enough, the promoter sells their entire position into that demand, and the moment the promotional campaign stops, the price collapses, leaving everyone who bought in during the pump holding a stock that's now worth a small fraction of what they paid. This isn't a rare fringe occurrence. One academic estimate places the annual cost of pump and dump schemes to American investors somewhere between $3 and $10 billion a year, and regulators have described the entire penny stock ecosystem as structurally vulnerable to exactly this kind of manipulation, precisely because of the thin trading volume and minimal disclosure requirements we already walked through. There's a case that shows exactly how this plays out, start to finish. Between 2008 and 2013, a California man named Zirk de Maison built nearly half a dozen small public shell companies, entities that conducted no actual business and held no real assets at all. Using bribe brokers in Ohio, California, and New York, and high-pressure boiler room call centers, he and his associates convinced investors across the country to buy shares in these shell companies for pennies each. As the buying pressure pushed prices up, de Maison and his original co-conspirators sold their own shares directly into that rising price. Once they'd cashed out, the promotional campaign stopped and the stocks collapsed, just as they always do. By the time the FBI and SEC finished unwinding the scheme, investors nationwide had lost approximately $39 million. De Maison pled guilty in 2015. He and 7 others were eventually sentenced to federal prison. Here's the structural lesson underneath that story. Nobody who bought shares in de Maison's shell companies was making a mistake in the sense of picking a bad business. There was no business to evaluate in the first place. The entire premise of the investment, from the very first shares sold, was that a later buyer, lured in by the promotional campaign, would pay more than the current price, with absolutely nothing underneath that expectation except the promoter's own marketing. That's not a risky version of investing. It's a different activity entirely, wearing the same clothing. Now compare that to what happens on the other end of this spectrum, when the exact opposite bet, one on an established cash-generating business, is simply allowed to compound over decades. In 1988, following the 1987 stock market crash and Coca-Cola's disastrous New Coke misstep the year before, Warren Buffett's Berkshire Hathaway began quietly buying shares in the company, eventually building a position of roughly 400 million shares at an average cost, adjusted for subsequent stock splits, of around $3.25 a share, for a total investment of approximately $1.3 billion. Buffett wasn't betting on a story, a rumor, or a promotional campaign. He was betting that Coca-Cola's global brand, pricing power, and asset-light business model would keep generating real profit year after year, and that those profits would compound. Today, that same 400 million share position, still roughly 9.3% of the entire company, is worth well over $25 billion. The share price alone has climbed somewhere in the range of 2,800% since Buffett's original purchase. But the share price is actually the less impressive part of the story. Coca-Cola has raised its dividend every single year since Buffett bought in, and Berkshire now collects more than $800 million a year in dividends from that single position, on a cost basis established nearly 4 decades ago. That dividend income alone now runs at a rate exceeding $90 million a month, generated entirely by a stock Berkshire has never needed to sell a single share of. The difference between these two outcomes wasn't luck, and it wasn't simply that one investor was more sophisticated than the other. It was the fundamental nature of what each investment actually was. De Maison's shell companies had no earnings to compound because they had no operations at all. Their value existed purely in the story being told about them, and stories, unlike audited profit, can evaporate the instant someone stops telling them. Coca-Cola's value was rooted in something that didn't depend on anyone's continued enthusiasm at all. Millions of transactions happening every single day, all over the world, generating real cash that gets reinvested and compounded year after year, regardless of what anyone happens to be saying about the stock on any given afternoon. That brings us to the structural risk sitting underneath the entire cheap stock category, and it isn't really volatility, though the volatility is real. It's the fact that a penny stock's price and a penny stock's underlying value are often almost completely disconnected from each other in a way that essentially never happens with a genuine blue chip. Coca-Cola's stock price can certainly fluctuate day to day, but underneath that fluctuation sits a business that will report actual revenue and actual profit every single quarter, verified by outside auditors, disclosed under strict regulatory requirements. A penny stock trading on the pink sheets may have none of that. The price you see isn't necessarily connected to anything happening inside a real business at all. It may simply reflect how effective this week's promotional campaign has been. Zoom out across both categories and the pattern becomes clear. The wealth that actually gets built and sustained over time in the stock market comes overwhelmingly from owning claims on real, profitable, growing businesses and letting the profit those businesses generate compound year after year, decade after decade, largely undisturbed. That's a genuinely boring process. It rewards patience over excitement, and it rarely makes for a dramatic story. The wealth that gets destroyed, on the other hand, tends to concentrate disproportionately in exactly the corner of the market offering the opposite promise. Quick, dramatic gains on companies with little to no real earnings, sold through hype rather than fundamentals, where a small number of early promoters profit enormously and the overwhelming majority of later buyers are left holding a stock that was never actually worth what they paid for it. So, does buying cheap stocks actually work as a strategy? The honest answer is that, statistically, for the overwhelming majority of people who try it, it doesn't. Not because cheap stocks can never succeed. Some genuinely underpriced small companies do go on to become huge, but because the mechanics of that specific corner of the market are structurally tilted toward the promoters who create the hype rather than the investors who buy into it. In the optimistic version, you find one of the rare legitimate small companies before anyone else does. And if it grows into something real, the multiple on your original investment can be extraordinary. In the realistic version, which describes most cheap stock investing, you're buying into someone else's promotional campaign at exactly the moment they're ready to sell into it. And the story that convinced you to buy evaporates the moment the promotion stops. Neither outcome has much to do with how cheap the share price looked when you bought it. A blue chip stock and a penny stock were never really the same kind of investment wearing different price tags. One is a claim on real, compounding profit, verified and disclosed, decade after decade. The other, in the overwhelming majority of cases, is a bet on whether someone else's enthusiasm outlasts your own. And history is fairly clear about which side of that bet tends to win.